The US debt just crossed $37 trillion. That's more than the next four countries combined. And it's adding $1 trillion every 3 months. Okay, so this is a kind of an old video from back in April, but I figured it's relevant since the US debt just crossed $37 trillion and it's growing by $1 trillion every 3 months. So let's go over it.
After the big tariff announcement, something happened that shocked economists, and it wasn't the stock market dropping. It was the value of the dollar dropping. Usually in times of market turmoil, it increases because investors are flocking to the US for safety.
We saw exactly the opposite. Money fled from the US for safety instead of to the US for safety for the first time in my memory.
That was a sign that something was getting different and that people weren't just shifting between U.S. assets. They were getting nervous about U.S. assets.
And that was unprecedented and something that woke up, I think, a lot of people about the issues associated with the debt.
That national debt was also one of the main reasons the U.S.'s credit rating was downgraded soon after.
It's not just people like me who've been talking about this for, a couple of decades. The economics is pretty clear.
So let's explain. If the national debt is concerning, when do we have to be seriously worried about it? But first, here's what the...
So in June, it was about 28 trillion. Is that what Wall Street Journal was saying? I don't know if that's correct. It was in the $30 trillion range, I think, at that point. But yeah, I don't know how much you guys know, but the U.S. is the reserve currency around the world. And normally, as the reserve currency, it's one of the safe haven currencies. So when there's wars or any sort of global crisis going on around the world, usually investors flock to safe haven currencies like the Japanese yen or the Swiss franc or the US dollar. So the fact that when Trump announced these tariffs, people fled the dollar, that signifies that the US is no longer seen as a safe asset. And we can see that de-dollarization really is coming into full effect now with BRICS and all these countries trying to diversify away from the US because the debt has become so large. And this is going to continue to affect us. In the US, it's going to lead to larger inflation, more and more inflation. Housing is going to become more and more expensive. Food prices are going to become more and more expensive. Cars are going to become way more expensive with these tariffs. Basically all kinds of goods are going to become a lot more expensive.
The debt even is. Congress spends more than it brings in through tax revenue. For 20 years, we've had a budget deficit. 2024's $1.8 trillion deficit was added to the combined deficits from the past years. This is the total running national debt. It's a lot. But obviously our economy now is bigger than back then, so here it is as a percentage of GDP. This is a better way of looking at it. It's still a lot. We're at World War II levels. And back then there was a good reason to go into debt. The US Treasury raised this money by selling bonds.
Buy a bond. You can be the guy that helps to buy the guns and planes and tanks.
They still do today, but most Treasury securities that fund the debt aren't sold via celebrities. They're sold at auction to private investors, to foreign investors. Lots of companies and pension funds keep their money in US securities.
Some government...
The next big crisis is going to be the sovereign debt crisis. The U.S. is going to fail on its bonds. You can already see, if you look at the Forex market, the U.S. dollar has gone down 10% since Trump came into office. So since the start of the year, the U.S. dollar has fallen 10%. That means that that's the largest drop since the U.S. got off the gold standard. So de-dollarization is in full effect.
Debt is actually a good thing because it allows households to basically save in a low-risk asset.
And sometimes it's necessary to go into debt.
Big recessions. We want to maintain the standard of living Pandemics. We borrowed a lot in the pandemic. Probably a really good thing to do in 2020.
That's exactly when you want to be able to borrow. The problem is we borrowed when we weren't in the crisis.
Which is how we got ourselves into a World War amount of debt. And carrying a large debt is concerning for a few reasons. For one, that's a lot of investors' money going to the government and not these other places.
When they buy a treasury security, they don't buy a corporate equity and give the money to a corporation to invest. They don't stick it in a savings account and have a bank loan it out to build a house. That $1.8 trillion is not available to whatever it may be that makes the economy more productive and allows us to live better. And that's why it matters to the average person. It's an opportunity that we're giving up by financing so much federal debt.
Studies have found that if the debt were to go down to here by 2050, incomes per person would be nearly 7% larger.
The thing about the national debt is it affects basically everything in our economic lives and then some, but we don't see it, we don't feel it, many people don't realize it.
And secondly,
It's not going to come down to 80%. I think the government now has just gotten so used to making the day-to-day operations work off of debt. So there is no intention to go off of printing more money, borrowing, issuing more treasuries, and just increasing that debt. And it's just going to continue to spiral and spiral until it becomes insurmountable and there's an inevitable crash. If you guys follow Ray Dalio, he talks about this. It's a cycle of empires and how they essentially collapse. And usually it starts with a large manufacturing base, which the U.S. had after World War II, and then consumers become very wealthy, and then from that wealth and from capitalism, the manufacturing sector ultimately gets moved to cheaper and cheaper countries because labor costs become so high, which is what happened in the 1980s, 1990s, when the U.S. pivoted all the manufacturing sector to China. And essentially what the U.S. is now is just a financial economy. We don't really have a whole lot of manufacturing. We don't have a whole lot of innovation going on, maybe outside of Silicon Valley a little bit. But basically what's happening is that we are just a fiscal economy. Everything is the stock market, the forex market. We're just lenders at the end of the day now, lenders and borrowers and investors. So essentially, once you reach the stage where you rack up a crap ton of debt, the next stage is usually some sort of major war where the empire tries to preserve its power. It tries to hold on to power, which is what we're seeing right now with the U.S. going and attacking Russia. It's going to start attacking China soon. It tried to attack Iran. And that's just the U.S. basically, the U.S. empire lashing out, trying to preserve its power. And what's ultimately going to happen is it's going to drive more and more countries away from the U.S. as it continues to lash out. And we're seeing that now. I mean, the U.S. is acting very brazenly against Europe, issuing tariffs all around the world, secondary tariffs to India for buying Russian oil. And it's just going to continue to drive these countries away from the U.S. and into a multipolar world. And it's going to make it harder and harder for the U.S. to borrow. There's going to be less and less countries willing to lend to the U.S. So the interest rates on that debt are going to get higher and higher, and it's going to become really insurmountable. We're probably going to end up going into a major world war, and that's going to be, after that world war, the U.S. empire is essentially going to be collapsed, just the same way the U.K. or the British Empire collapsed after World War I.
Well, this is what the government spent in 2024. Social Security and healthcare are obviously the big ones. But here, more than was spent on the military, more than everything else spent to run the government, were interest payments on the national debt.
We have so much debt that we're borrowing to pay the interest on the previous debt. Well, that's like getting a new credit card to pay off the old one, and if you're doing that, you're in trouble.
So right now, if interest rates go up just 1 percentage point more than they're expected to, it adds about $300 billion in borrowing a year.
So if some debt is good, but too much debt can be bad, when does it become bad, like unsustainable bad?
If the publicly held debt goes above roughly 175% of GDP, things get pretty hard at that point, and 200% is really the drop dead limit. And the reason why is once you hit that limit, you couldn't possibly raise taxes enough at that point to meet the interest payments.
That's the Greek-Portugal meltdown scenario. And when that happens, number one, usually your economy's not in very good shape, so it's not generating a lot of income, so you can't tax it, you can't pay the debt. Suddenly your interest rates go way up because the borrowers want their money back. No one can afford anything. You get a recession on top of everything else. You're having to raise taxes to pay off the borrowers who are demanding their money. They don't care how you're doing. And it's a really, really bad situation, and one that should be avoided because it can be avoided. Because once you're in there, there are no good choices.
So we did this as an outer bound exercise. But some people ask, when could things unravel? Before that. And the answer is, it could be tomorrow. As soon as capital markets believe that Congress and the president are not going to get their act together, everything unravels. And it unravels very quickly.
Sure, this could be triggered when we just objectively borrow more than we can pay back. But whenever investors feel that the US isn't the safest place to put their money, they demand a higher interest rate. That's what happened after the tariffs when the dollar went down.
The dollar's only valuable if you want to hold something that you buy with dollars, and that would be treasuries.
And since the US Treasury has always paid its debt and interest on time, the US securities are considered the least risky investment. So they have the lowest interest rate of anything else on the market. So if interest on a US security goes up, so do mortgages. So do even the safest AAA rated corporate bonds. Everyone in this market is affected.
It ripples through the entire economy.
So essentially, housing and everything associated with consumerism in the U.S. is going to get more and more expensive. It's going to be more expensive for us to buy cars, more expensive for us to buy houses, more expensive to just live. So, yeah, not a good sign.
Economy in ways that hurts all of us.
If this happened on a larger scale and interest rates really went up for everything, it could spiral into a fiscal crisis.
The problem with a debt crisis is that once it happens, you can't just debt your way out of it.
We might be able to borrow during the next crisis. All we know is we have less space to do so than we otherwise would have.
We're not there. We're not going to be there tomorrow. But, I always tell people, look, there's no point in finding out how long the world will wait. Let's not run the experiment. Let's just fix the problem and avoid the crisis.
Okay, how? How can the national debt be fixed? Some policymakers argue if the US economy does better, we can basically grow our way out of it. If more people make more money, that's more tax revenue, that's higher GDP, this ratio gets smaller. Economists say this could work if the debt wasn't already so big and spending wasn't also growing.
You can't.
This is just a dumb conversation. Like, people in the U.S. are losing jobs. They're not making more and more money. We're heading into a major recession. It's not going to be higher wages, essentially. I mean, the American worker is being forced out of jobs because of all this debt that the U.S. has accrued. All these major corporations are working and operating on major debt. And because of the way everything is structured with congressmen and corporations all beholden to their very short cycles with re-elections and with board members and investors, all these companies operate on very, very difficult playing fields, right? Like, a congressman is not going to go and increase taxes on the American consumers to try and bring the debt down because he wants to get reelected. And so they're just going to keep borrowing more and more money. And honestly, at this point, we already can't afford to pay more taxes. Only the top 1% can. And they are getting bailouts left and right. So it's not really going to get much better. We're just going to continue trending towards that 200% and inevitable collapse.
You can't grow your way out of this. Most spending is already tied to economic growth. You solve the fiscal problem, the spur economic growth.
And experts say the solution to the debt is simple. Congress needs to spend less and bring in more.
We need to do some hard things. We need to honestly fix Social Security, which is headed towards insolvency. Same with one of the trust funds in Medicare. Those require real choices. We do have to make changes to our welfare programs. We do have to look at how our defense procurement programs work and all the money that's wasted there. We do have to put discretionary spending caps on, and we do have to raise taxes. All of those.
Cut the national defense budget. Stop funding all these foreign wars. That's an easy win. Like, why are we sending wars to Ukraine and I can't say the name of that country, but yeah, why are we sending money to fund all these foreign wars? We're going to be starting another foreign war in Taiwan. We're going to just keep funding foreign wars. It's an easy win if we just cut the national military industrial complex budget. So
things which are like not popular political slogans, they have to get done.
We need a grand bargain that says everything's on the table.
It doesn't have to be draconian, but it does have to be different than what we're doing now.
So is the debt bad? It's not until it suddenly is.
it's bad.